SHEL. We all know it, right? It's a massive global energy giant, a total FTSE 100 stalwart, and honestly, the absolute bedrock of countless investment portfolios all around the world. Usually when analysts are talking about SHEL, what are they looking at? They're hyping up the price-to-earnings ratios, dividend yields, free cash flow, and those massive share buyback programs. Basically, they are obsessed with the shiny stuff printed right there on the front cover of the annual report. But in this explainer, we're doing things a bit differently. We are flipping that report completely over. We're going to dive into the hidden structural risks that the broader market just seems to be completely ignoring. So to truly get a handle on the underlying risks of this energy behemoth, we really have to look past those attractive quarterly dividends. Here's exactly what we're unpacking today. Number 1, governance and audit failures. Number 2, toxic environmental liabilities. 3, the reserve life crisis. 4, borrowing from tomorrow. And 5, the executive pay disconnect. Because here's the core problem we're tackling today. On one hand, you've got those front cover metrics, the rosy, highly publicized financial numbers everybody loves. But then you flip the book over and bam, you're hit with the back cover reality. We're talking about massive signals buried deep in footnotes, court filings, and regulatory disclosures. These are things that simply won't show up in a basic return on invested capital calculation. But honestly, they might actually matter way more to the long-term survival of the company than any traditional financial metric. All right, let's dive into red flag number 1, governance and audit failures. Or, as I like to think of it, the watchdogs falling completely asleep at the wheel. Get this, the timeline of this compliance failure is just astonishing. The whole issue centered around a guy named Gary Donald, who was the lead audit partner for SHEL from EY, one of the big 4 accounting firms. Now, under both US SEC rules and UK Financial Reporting Council requirements, an accounting firm is legally required to rotate its lead audit partner every 5 to 7 years. It's just basic independence protocol. Well, Donald completely exceeded that limit. He stayed on as lead auditor for SHEL's 2023 and 2024 accounts, and for 2 full years, nobody noticed this. Finally, in July 2025, EY self-reported the breach. The fallout? It was brutal. By December, 4 EY partners had left the firm, including the partner who's actually in charge of EY's internal compliance. The UK's Financial Reporting Council launched a formal investigation, and SHEL abruptly axed EY's massive $66 million a year audit contract. Now, EY self-reported their own mistake, but what on earth was SHEL's own audit committee doing? Their entire job, literally their primary mandate, is to monitor auditor independence. And yet, for 2 whole years, a blatant rotation breach happened right under their noses. So as an investor, you really have to ask yourself, if basic partner rotation rules weren't even being monitored, what else is being missed? This isn't just a minor accounting hiccup by EY. This is a profound structural governance failure at SHEL. Which leads us to red flag number 2, toxic environmental liabilities. This is all about what happens on the ground, and it's basically the illusion of a clean exit. Back in March 2025, SHEL sold its Nigerian onshore subsidiary to a newly formed company called Renaissance Africa Energy Holdings. SHEL totally framed this as a clean break, but for the communities living in the Niger Delta, this so-called exit looked a whole lot more like an escape. Just look at this staggering number, 110,535. That is the number of barrels of oil, we're talking roughly 17.5 million liters, that were spilled in the Niger Delta between 2011 and 2017 alone. And that's according to SHEL's own data. They are leaving behind literally decades of severe compounding pollution. And those spilled barrels, they translate directly into massive financial and legal exposure. To put it into perspective, the estimated cost just to repair the environmental damage in one single state, out of the 9 Niger Delta states where SHEL operated, is at least $12 billion. Now you might be thinking, well, they sold the subsidiary, so problem solved, right? Actually, scratch that. Not exactly. In June 2025, a massive UK High Court ruling confirmed that SHEL and its former subsidiary can absolutely still be held legally responsible for the historical pollution. On top of that, UN human rights experts have formally warned that these kinds of asset sales might actually violate international human rights law. And here's the craziest part. Buried deep in the annual report, SHEL disclosed that they actually provided the buyer, Renaissance, with a $2.5 billion loan facility just to get the deal across the finish line.
Which brings us to a terrifying scenario if you're holding this stock. Nigerian regulators initially rejected this sale because they were genuinely worried about Renaissance's financial and technical capabilities. So if this newly formed buyer simply cannot afford the multi-billion-dollar cleanup costs, who ultimately pays? Shell says it exited, but legal liability for historical pollution doesn't just vanish into thin air because you signed a paper. We're talking about a massive contingent liability that could easily hit the tens of billions of dollars. And you know what? It's almost entirely missing from standard analyst models.
Let's shift gears from the past to the future for red flag number 3, the reserve life crisis. Basically, they are running on empty. For an energy extraction company, reserve life is arguably the single most important metric out there. It just measures how many years the company's proven reserves can sustain output at current production rates. And as of 2025, Shell's reserve life has plummeted to less than 8 years. Just look at how they benchmark against their direct peers here. Shell is sitting at 8 years, ExxonMobil is at 12, and Total Energies is up at 13. Shell is quite literally the absolute worst in the industry right now. This drop was so dramatic it actually triggered RBC Capital Markets to downgrade Shell, calling it a material step down and warning that these longevity concerns are just going to linger. To give you a sense of scale, Shell's total proven reserves have dropped to 8.1 billion barrels of oil equivalent. That's the lowest we've seen since at least 2013. Even CEO Wasail Sawan has acknowledged this. He warned investors that declines across their portfolio would leave this massive gap of 350,000 barrels per day by 2035. That's the gap between their production goals and what their current assets can actually pump out. Now, management will confidently tell you this 2030 liquids gap is effectively solved, but we have to read between the lines here. Effectively solved in this industry usually means one thing. They're going to have to go out and buy new assets. And buying assets requires massive amounts of cash or issuing new shares, which just dilutes shareholder value. Bottom line, if an oil company doesn't know where its oil is coming from in 10 years, that structural risk is absolutely immense. Which perfectly transitions us into our 4th red flag, borrowing from tomorrow, the debt spiral. Let's talk about cash. Because honestly, you don't need a PhD in finance to see the glaring problem here. In August 2025, HSBC downgraded Shell from buy to hold, and the main reason was this terrifying trajectory in their debt profile. Let's just walk through the math together. HSBC projects Shell's annual operating cash flow to be roughly $40 billion through 2027. Sounds like a ton of money, right? Well, until you look at what's going out. They need $20 to $22 billion for capital expenditures just to keep the lights on and try to fix that reserve crisis we were just talking about. Then they've got $22.5 billion completely committed to those attractive dividends and share buybacks analysts love so much. Throw in another $5 billion for lease payments, and suddenly you have $47.5 billion in cash going out the door. So $40 billion coming in, $47.5 billion going out. That creates a structural shortfall of $5 to $7 billion every single year. So how exactly does a company fill a multi-billion-dollar cash hole while still aggressively buying back its own stock? Simple. They put it on the balance sheet. Because Shell is spending way more than it earns, HSBC projects that net debt is going to climb from around $43 billion in the second quarter of 2025 to over $60 billion by 2027. That is a staggering 50% rise in debt in just a couple of years. Their gearing, the debt-to-capital ratio, is expected to climb right up into the mid to high 20s. The market might be absolutely loving those share buybacks today, but this proves those returns are being artificially sustained. Shell is quite literally borrowing from tomorrow to pay for today. Okay, let's hit our 5th and final red flag, the executive pay disconnect. It's a look at internal culture and how leadership is basically rewarding failure. So in 2025, Shell reported its adjusted earnings fell to $18.5 billion. That's a 22% drop from the previous year, and it marks the company's 3rd consecutive year of falling profits, 3 years down. Yet, in that exact same year, CEO Wal Sawan's total compensation jumped by almost 60%, hitting a massive £13.8 million. I mean, think about that. When profits fall by nearly a quarter and the CEO's pay skyrockets by more than half, the whole concept of pay for performance is just completely broken. Now, Shell's official excuse for this was that it was the first time the CEO could tap the full policy as part of a 3-year cycle. Essentially, they're saying, hey, we contractually promised him this money 3 years ago, so it doesn't matter how we're performing today. And it's worth noting, only $1.9 million of this was his fixed salary. The remaining $11.8 million, that came entirely from bonuses. As Andrew Speak from the High Pay Center pointed out, with everyday consumers stressing over rising energy costs, this hefty pay rise amidst falling profits is incredibly jarring. It sends a very clear signal about a boardroom culture that prioritizes massive executive payouts over a sustainable long-term capital allocation. All right, let's pull all of this together.
because we have uncovered 5 massive, interconnected red flags hiding on the back cover of SHEL's ledger. A severe audit compliance failure entirely missed by the very committee designed to catch it. A looming multi-billion-dollar environmental time bomb in Nigeria masked by a super complex exit sale. An industry-worst reserve life of under 8 years that leaves them absolutely scrambling for future oil. A structural debt spiral projecting a 50% jump in net debt just to keep funding current shareholder payouts. And finally, an executive compensation culture that rewards leadership with 60% pay bumps while company profits fall for the 3rd year in a row. These are the absolutely critical risks that you are simply not going to hear discussed on a standard upbeat earnings call.
If you're analyzing this stock or really just trying to understand the long-term sustainability of these legacy energy giants, these hidden details are exactly what you need to be focusing on. Because at the end of the day, when you're looking at a massive extractive industry like this, the most important question isn't how much cash it prints today. It's what is actually left in the ground and on the balance sheet for tomorrow. Thanks so much for joining me for this explainer. Keep questioning the consensus and always keep digging into the back cover. Catch you next time.